All right, I hope you all had a fantastic weekend. I know I did. If you didn't, hopefully my video today will help improve your mood for the week. I'm going to be going through each and every one of the bearish points that exist in the stock market today, and I'm going to be giving you my research, my opinion, my due diligence, and my counterpoints to those bearish points, and hopefully prove to you why I am bullish and I remain bullish on both the stock market and the economy. You know, for the past 2 years, I'll just say it, there's been a lot of garbage that's been put out there from different members of the media, different pundits, or other influencers on social media, whether that be X or YouTube. These people have been calling for a recession or a depression for 2 straight years, and they've been so wrong about it. And, you know, I think that the part of it that really upsets me the most is the fact they've done a major disservice to their viewers. They get paid to make these calls that are absolutely trash, and in the end, it just influences some of their viewers to sell completely out of the markets. And if, let's say they even influenced one person, if that person has been out of the markets for the last 2 years because of what they were saying 2 years ago, they've missed out on a tremendous rally in the stock market. So I don't know how these bears continue to get away with it. They continue to get the clicks and the viewership. But hopefully this video is going to help kind of stem the tide and give you the counter argument that nobody else will. I honestly don't think the bears do, at least the current iteration of the bears, they're not doing the work and the research needed to be successful at this game. And that's why they've been wrong for so many years in a row now. And I don't think it's changing. One of the things I'll mention before I get into these bearish points and dissecting them is We've been on fire on this YouTube channel doing this sort of thing, looking at economic data points and interpreting how the markets might react to them. What a lot of people comment that disagree with me, or what a lot of the bears and the hard landers comment is they'll say you're using rigged government data, but then they'll go out and use the same government provided data to try and prove that we're in a recession. You can't do that. That's totally backwards. You can't, on one hand, claim that government-provided data is manipulated and then go use that same government-provided data to say we're in a recession. So it's a little backwards to me. It's kind of funny, the irony of that. But yeah, I mean, if you've been buying this dip, let me know down in the comment section below. Also, on your way down there, hit the like button, subscribe button for me. We have one of the fastest growing stock market YouTube channels on this platform. I would love to continue that, of course. I mean, I'm slightly biased. It is my YouTube channel. But yeah, if you're new here, please subscribe and hit that like button for me. It helps me out tremendously. Without further ado, let's jump into this. Today, the NASDAQ is up 0.84%. It's really doing its thing. The Russell 2000, my small caps, they are outperforming again, up more than 1% on the day. And, you know, this week, it's not going to be that heavy on the economic front. We're going to get kind of a break. The headlines are going to be mostly centered around Jerome Powell's speech at the Jackson Hole Symposium on Friday at 10 a.m. Eastern Time. But this morning, we did get an update on one of the economic indicators that bears have continued to point to and they've continued to be wrong about. So, in this morning actually probably helps their case a little bit, but I still think it's very wrong. So, this is the leading economic indicators. What the leading economic indicators tell us is that when they're falling, surely we're in a recession or we're about to enter one. And we got July's update this morning, and July's leading economic indicators fell more than forecast, down 0.6% month over month versus the estimate of being down 0.4%. On paper, that looks good for the bears and the hard landers. And they're even going as far as extrapolating this out, saying that this is the 29th month where leading economic indicators have plunged, and it's worse than the great virus crisis lockdowns. I mean, that's how extreme the bears are getting right now. This chart here, I'll show you, the leading economic indicator index here. It's the red line, and how it's been plummeting for years now. Yet this recession and depression is just still, it's a no-show. It's a no-show. And the reason for that is, and this will be a common theme in today's video, it's because of economic shifts that have happened that bears and hard landers haven't paid attention to, or they're just simply unwilling to do the work for, or they just simply don't want to believe it for whatever reason. We can look at the leading economic index and see that it's made up of 10 components. It's average weekly hours in manufacturing, average weekly initial claims for unemployment insurance, manufacturers' new orders for consumer goods and materials, ISM index new orders, yada, yada, yada. Bottom line, 5 of the 10 components, at least 5 of these 10 components, heavily weight the goods sector of our economy. That might not sound like a problem at first, but the problem herein lies that the goods sector of our economy is very small compared to what it used to be. Back in the 1950s, the goods sector of our economy made up more than 2/3 of our total GDP. Today, that's down to 1/3. And the services sector has done the opposite. The services sector has gone from being 1/3 of the GDP to being over 2/3 of the GDP today. So the services sector and the goods sector have completely switched places. And that's a big problem if most of our economy is dependent on services and not goods, and at least half of the leading economic index is weighted towards the goods sector of our economy. That's a big problem. I'm a bull on the stock market, I'm a bull on the economy, but even I have acknowledged that the goods sector has been going through a rolling recession. It's been struggling a little bit. But the reason it hasn't brought down the whole economy is because it makes up such a small percentage of investment, production, consumption, and employment. And that's a big problem. That makes the leading economic indicators misleading economic indicators. And this is research and data that the bears and the hardlanders don't want to do. I'm sure I'm going to revisit this point several times in today's video, but the red highlighted lines are the different components of this index that are weighted towards the goods sector. And of the remaining 5, virtually none of them are focused on the services sector. I mean, we have average weekly initial claims for unemployment insurance. That's neither goods or services focused, but even the employment sector is a little bit misleading. I'm going to get into that in a little bit. We have the S&P 500 index of stock prices. That doesn't have anything to do with goods or services. And the leading credit index doesn't have anything to do with it. The interest rate spread, so this is the yield curve inversion that everybody talks about. That's one of the 10 components of the leading economic indicators. And I just did a video, I think it was Friday I uploaded it. I encourage everybody to watch it. I made a video on the yield curve inversion and the disinversion and why it's so misleading today. But this is not a recession indicator, the yield curve inversion. So a lot of people believe that when the yield curve inverts or it disinverts, it's predicting a recession. Based on my research and the research at Yardeni Research, who I almost idolize, they do great stuff over there. The yield curve being inverted simply means that the risks of a financial crisis are rising in the system. And if we get a financial crisis, it still doesn't mean we're going to see a recession because the Federal Reserve can step in and add liquidity to the system. We saw this happen in March of 2023. We had our financial crisis. Something did break. Silicon Valley Bank and some other regional banks were failing. And what did the Fed do? They introduced the Bank Term Funding Program, and that stymied that sort of cycle. I went through 4 stages. This isn't, the yield curve's inverted recession. It's the yield curve's inverted. Investors are increasing the risks or their odds that something might break in the financial system. And if we do get a financial crisis, it can turn into a credit crunch, which can turn into an economy-wide recession. In March of 2023, the Fed stopped that cycle at financial crisis. We got the financial crisis, the banks failing. They saved the banks, and they added liquidity to the system when we needed it. So that was a little bit of a tangent, but if you haven't seen that video, go watch it. Click the eye in the top right-hand corner. And then the last component was average consumer expectations for business conditions, which maybe is somewhat services focused, somewhat goods focused, but bottom line, none of these components are focused on the services sector of our economy, which has been holding us up while the goods sector has been falling and has really been struggling. So in my opinion, because of these reasons and because of the great economic shifts that have taken place, the leading economic indicators or the leading economic index probably needs a product recall because it's simply inaccurate by today's standards and because of the things that have changed. But let's talk about unemployment, because when people say we're going to enter a recession or they're fearful we will enter a recession, they point to basically consumers. They think we're going to have a consumer-led recession, which means that unemployment is going to skyrocket because you cannot have a recession if unemployment is not rising. Good news for the bears and the hardlanders is unemployment has been rising. But again, they stop their research there. They see this chart and say, unemployment's rising, and as a result of that, unemployment's going to skyrocket and we're going to enter a recession. If you do the research, and I'll show you some charts here, the reason the unemployment rate is rising is not because people that have jobs are losing their jobs. It's primarily because of immigration and illegal immigration, basically re-entrance or new entrance into the labor force that is making the unemployment rate rise. It's not people losing their jobs for the most part. It's the overall labor base increasing in number. And in fact, we can look at announced layoffs and see that in July, the amount of announced layoffs actually plummeted. And if unemployment was rising and people were getting fired or let go, announced job layoffs would skyrocket. They wouldn't plummet like they did in July. And I'm sure if you've been listening to the Bears, you probably have never seen this chart because it doesn't feed into their thesis. In fact, it goes against their thesis. And something we pointed out a couple weeks ago was, people were starting to fear the initial and continuing unemployment claims rising. We were up here at 250,000 a few weeks ago. And on this YouTube channel, you can go back and find the video. We discussed how this was almost entirely weather related. And as a result of that, over the last 2 weeks, so the first 2 weeks of August have showed really strong labor market data where initial and continuing unemployment claims have fallen. And if we're going to enter a recession or if we're in a recession, that doesn't happen. The reason unemployment claims rose was because of Hurricane Beryl, which made landfall on Texas in the month of July, which made July's labor market data appear really weak. And as a result of that, investors started to fear this recession and they started to price in an abundance of rate cuts. And again, I think the amount of rate cuts, I think the markets are getting a little overzealous about them again. Not much different from the way the markets were pricing in 6 or 7 or 8 rate cuts at the beginning of 2024. We're already basically to September, not quite September, but middle of August, and we've yet to see our first rate cut. I think 2025 is going to show a similar story where investors are pricing in all of these rate cuts, and we don't end up getting nearly as many as they think we will. We also showed this chart here, where in the month of July, this is astounding. Like, you can't ignore this stuff if you're bearish. At least be honest, be subjective a little bit. In the month of July, workers not at work or working part-time due to bad weather reached 1.54 million workers, up from basically 250,000 in the month of June. So over 1 million workers were displaced in the month of July because of weather. And bears just didn't do this research, or they ignored this research because it didn't feed into their thesis. Like, give me a break. Now, regardless of that, the bears just kind of kept going with this mantra, and we had people calling out the Sahm Rule. And Goldman Sachs had an update today. They said, after the July jobs report released on August 2nd triggered the Sahm Rule, we raised our 12-month U.S. recession probability from 15% to 25%. Now we have moved it back down to 20%. That was the update today. What bears did after the Sahm Rule was triggered is they said, this means we're going to enter a recession. And to be fair, the Sahm Rule has been very accurate historically. But again, dig a little deeper into the data. Don't just read the stuff that people post. Dig a little bit deeper. And that's what I aim to do on this YouTube channel. If we dig into the Sahm Rule in the state of the labor market, it shows us that this time it's probably going to end up being misleading. Carl from CNBC put this out. I think it was this morning. Yeah, it was this morning. He said the U.S. unemployment rate is currently 0.9% off the cycle low. In the last 55 years, in the 3 months following the month when the unemployment rate rose, yada, yada, yada. Everything that bears and hardlanders are pointing to in regards to unemployment right now is centered around the Sahm Rule or indicators very similar to the Sahm Rule, where they take 3-month rolling averages of unemployment and compare that to, the low mark over the last 12 months, for example. That is so silly to me. All that these indicators, all that the Sahm Rule tells us is that a rise in unemployment is typically preceded by an initial rise in unemployment, which I don't know if I need an indicator to tell me that. To me, that seems fairly obvious that if unemployment is rising, it's preceded by an initial rise in unemployment. Like, what are we doing here? So let me get into the Sahm Rule and all these indicators flashing recession that have predicted recession with 100% accuracy, supposedly in the past. Let's discuss this. This chart here will show you the Sahm Rule, and then it'll show you the Sahm Rule using the insured unemployment rate. You can see if you use the traditional Sahm Rule, yes, it's been triggered. But if you use the insured unemployment rate, the Sahm Rule is at 0.0, so not even close to being triggered. And the reason we would use the insured unemployment rate is because this strips out all of the illegal immigrants and the people that are unable to obtain insurance, workers' insurance, which typically is illegal immigrants, right? Kind of makes sense logically. And you can see here, based on this chart too, the insured unemployment rate is at 1.2%. 1.2% of insured workers are unemployed right now. 1.2%. And this has hardly risen since 2021, since 2022, since 2023. Hardly risen at all. It's pretty flat. The only unemployment rate that continues to rise is the normal unemployment rate that takes into consideration all workers or available workers in the workforce, whether they're legal or illegal immigrants, whether they're seeking jobs or not seeking jobs. And this is another chart that tells us it's not people that have jobs that are losing their jobs that is causing the unemployment rate to rise. I mean, we can look at the insured unemployment rate and see it. It's been flat. It's simply new entrants, re-entrants into the labor force that's causing the unemployment rate to rise. That is a huge dichotomy, a huge difference when you're trying to decipher what the economy is doing. It's a huge difference that you have to pay attention to. Now, the next most popular bearish argument tends to be consumer debt and the way consumers are financing their lifestyles via credit cards. And while some of that is true, there's some things we need to take note of here. First of all, credit card balances only make up about 8% of total consumer debt outstanding. 8%. 8%. So if the consumers that are financing their lifestyles via credit card end up failing or falling out, it's really not going to cause a credit crunch or a credit crisis that could turn into an economy-wide recession because there really isn't that much debt that is leveraged up on credit cards right now. Most of the debt outstanding actually comes from mortgages, and the amount of mortgage debt that consumers hold is $12.5 trillion. That is a much larger number, which might start to concern you. And some bears point to this too. They say, well, we're going to have a housing-led recession. The problem with this is despite there being $12.5 trillion of mortgage debt outstanding, 40% of homeowners don't have mortgage debt. 40%. That's a huge number of the amount of homes that are owned out there. So that makes the odds of a credit crunch caused by the housing market go way down as well. So ultimately, there really doesn't seem to be that big of a risk when it comes to debt in the system and consumers being over leveraged right now. And another point that bears and the hard landers kind of disregard is the fact that, of course, debt balances are at all-time highs. I mean, how many trillions of dollars have we printed in the past 4 years, in the past 6 years, in the past 8 years? It's astounding the amount of dollars we've printed. So it's also no wonder that asset prices are at all-time highs. It's no wonder that debt balances are at all-time highs because there's simply more money in the system because of inflation. If you're still not sold on consumer debt being a potential issue, let's look at affordability of credit card debt and consumer debt. We can look at consumer credit outstanding as a percent of disposable personal income. Disposable personal income is the money that's left over after consumers make the purchases they absolutely have to make. Their needs, not necessarily their wants, but their needs. Consumer credit outstanding as a percent of disposable personal income has been falling since 2021, meaning that consumer credit outstanding is much more affordable when you compare it to the amount of money consumers are taking into their wallets. This chart here shows a very similar thing. This is the ratio of debt service payments to disposable personal income. And you can see here too, this has been falling since the great financial crisis of 2008 and 2009. It has been falling, and despite it bouncing back since 2021, because, I mean, of course, debt was super affordable during the great virus crisis because the Fed printed money for consumers to spend wherever they needed to spend it. Disposable incomes were very high despite people not having as many jobs because of all the stimulus. Anyways, it's been downtrending, which means that the consumer's ability to finance or service their household debt has gotten much easier. If this ratio was up where it was during the great financial crisis of 2008 and 2009, I think the bears and hardlanders would have an argument here. But it's nowhere close to that, and it's continued to fall. And we can talk about consumer credit and consumer debt all we want, but we also need to, look at the other side of the equation, consumer wealth, the amount of money consumers have. We can look at data from the Bank of America. They have one of the best, they have the best access to American consumers out of any company in the United States of America. Based on their data, and this report just came out a couple days ago, median deposit balances remain almost 40% above pre-pandemic levels and over 15 percentage points above inflation-adjusted 2019 levels. So there's more money in consumer balances and in consumer deposits than there was prior to the pandemic. Now, this report kind of has a bearish twist to it, and I don't really like this either. They say, despite them being 15 percentage points higher than inflation-adjusted 2019 levels, they have declined to near their lowest post-pandemic level. So this is true and all, but right now, okay, our economy is so much different. First of all, usually consumer balances at banks decline during the summer months as people take vacation. Makes sense. But also, right now, we have interest rates at 5%, which means people can take money out of their bank deposit balance and put it into higher yielding assets, I guess you could say. You know, whether that's treasury bills, whether that's treasury notes or bonds, whether that's corporate debt, whatever it is, you can get a higher, even risk-free yield if you buy those treasury securities than we have been able to in over a decade. It's been a long time since we've had the ability to get this sort of return on our money risk-free. So that too is decreasing deposit balances at banks somewhat. But even so, on an inflation-adjusted basis, we are still 15 percentage points higher than 2019 when it comes to median deposit balances. That's a really positive thing when it comes to the overall quality of the consumer right now. And then we have this. I've brought this on the channel. I'm going to zoom out quick. I brought this on the channel a few times, and it's a huge demographic thing that everybody, I don't care if you're a bull, I don't care if you're a bear, you have to pay attention to this. It's the level of household net worth held by the different generations right now. And we can see that the baby boomers have $78.6 trillion of net worth. This is a record high, and the next closest record high is not even close. So $78.6 trillion of net worth that the baby boomers have right now. And all baby boomers are either retirement age or they're entering retirement age at this stage. And they're retiring with an itch to spend their money. And the great virus crisis only expedited that, only increased that itch to spend their money. And even if this doesn't get spent on travel or entertainment or food services, this is money that will get passed down to the next generation. And so even if you say, well, yeah, I mean, the baby boomers are doing well, but the rest of the generations aren't doing so well, this wealth is going to go somewhere. It's not just going to disappear into thin air. It's going to be passed down to the next generation. And even so, you know, more and more teenagers, more and more young adults are coming back to live at home after they graduate college or after they graduate high school if they enter the workforce. So baby boomers have the ability to provide for the younger generations, whether that's helping them with a down payment on a home, a house, whether that's helping them with debt payments, repaying their student loans, whatever it is, this is only a positive thing for the economy. And this is a major demographic shift that a lot of people aren't paying attention to. And I think it's very, very important. That's a lot of money, $78.6 trillion in net worth. Next, we just got an update to the federal government's budget balance. I mean, that's super exciting, right? The good news here is that the budget deficit decreased year over year. So, I mean, that's a positive thing. The bad news is that we're still on an unsustainable path when it comes to, deficit spending at the government. So there's that. But there is some non-recessionary data kind of hidden within the federal budget deficit. We can look at U.S. federal tax receipts, which climbed again, which is a very good signal about the economy. And it rose mostly because of individual income tax receipts going up, which means that people are making more money, which obviously is a good thing for the economy. The biggest point here that I want to make, though, is actually in U.S. federal government outlays. And we can see that income security payments have been falling and falling pretty rapidly. That's the green line on this chart here. If income security payments are falling, it means that less people are applying for unemployment benefits or unemployment insurance or unemployment payment, subsidy. So this is a very good thing, and there's no recession in this data. If we were entering a recession or if we were in a recession, the government's outlays for income security payments would be skyrocketing. You can see that basically in any recession, which is the gray bar on this chart, any of the gray bars on this chart. So let's end this video by discussing what I'm personally doing. And this is not financial advice. This is just what I think is best based on my research, my opinions, and my own knowledge of my own financial situation. I am going long small cap and mid cap companies. It's a known fact that if interest rates fall, these are the companies that are going to benefit the most. All you have to do is look at the way small caps and mid caps have underperformed the rest of the markets as interest rates have increased. Because if interest rates increase, obviously the risks of recession rise theoretically, and smaller companies are much more dependent on debt to grow. So that's kind of a double-edged sword for small cap and mid cap companies when interest rates are going higher, but it is a double-edged benefit when interest rates are set to go lower. I don't personally think we need interest rate cuts right now. Despite my personal belief and my personal opinion, it's a known fact that interest rates will be cut. They'll be cut by 25 basis points, I believe, in the month of September. I personally don't think we will get as many rate cuts as the markets are pricing in right now. But regardless of that, interest rates are set to come down, and the small cap and mid cap companies will benefit the most. Further, for the first time since 2020, small cap and mid cap companies are set to outpace the large caps when it comes to revenue growth and earnings growth. That's a huge deal that I don't think the markets are really prepared for, and it's going to hit them right across the face when it happens. You know, the markets always are chasing after where the growth is, where the best growth is. And at some point, as these earnings reports come in, you know, this could be 2-3 quarters down the line, the market's going to wake up to this. Oh, small caps and mid caps, they're now the most healthy businesses to invest in. I'm going to put my money here, and maybe I'll sell some of my large caps to finance these purchases. So I personally believe, this is my thesis about the markets, no guarantees I'm going to be correct. I think that the NASDAQ and the S&P 500, for the most part, are going to chop below, maybe slightly above their all-time highs until the November election. I think they're going to be pretty flat when we come back and look at this, you know, look at its performance in November around election time. During this time period, though, I think that the laggards, so the small caps, and this has been happening, it's been playing out, we've been correct with this, the small caps, fintech companies like Robinhood and PayPal, those will be the new leaders. The laggards will become the leaders. The leaders will become the laggards. And if you lag, it doesn't mean you have to be red. It simply means that you underperform the small caps, like the NASDAQ did today, although it wasn't that much, but they still lagged. I think this is going to continue. And ultimately, I think small caps are in for a tremendous 12 to 16 months. I think the NASDAQ and S&P 500 could perform just fine during this time period, but I think your best returns will be in small caps. So I'm positioning my portfolio in that direction. I've gone as far as saying I'm putting together an A-list of companies that I believe are tremendous deals in small cap and mid cap land. You guys have been loving that list. I give access to it first and foremost to my paid monthly members because I'm entirely self-funded. I'm independent, and you know, ultimately, I have to support the people that support me. But we've released 2 or 3 of those companies. The next one I'll be releasing publicly soon, maybe tomorrow. But I also have some other ones I'm looking into today that I might be releasing to my members first here really, really soon. So if you want to join that membership and help me out, it means a lot to me. Just the fact you're still watching this video at this point means a lot to me, though. Just want to make that clear. But if you want to go a step further, it does mean a lot to me. You can hit the join button located right next to the subscribe button, or you can hit the Patreon link in the pinned comment. But yeah, that's where my portfolio is going right now. I think as a result of interest rates going higher, all small cap and mid cap companies have kind of been punished equally, which means there's tremendous opportunity out there for companies that are grouped into that group that have really good balance sheets, have really good business models that have been punished unfairly. And those are the sort of opportunities I'm after right now. So far, so good. Hope I can find kind of a handful more of those. Now, I will say the one bearish argument I didn't cover too in depth in today's video is just the risk of geopolitical tensions rising overseas. This is always a risk as an investor, but typically it doesn't impact the stock market that much. And if it does, it's a short-term move. We've seen this in the past couple of years with the different tensions and conflicts that have arisen. Stock market might feel some short-term pain, but ultimately we just go higher. So I'm not too concerned about geopolitical tensions rising. If you are concerned about it, I would suggest maybe going overweight energy and oil and gold in your portfolio, kind of as a geopolitical tension shock absorber for your portfolio. Energy honestly hasn't performed that great this year. So it's not that hard to be overweight energy. It only makes up like 4 or 5% of the S&P 500. So if you're 6%, 7% energy, you're overweight that sector. That's one way you could hedge. So I just wanted to put that out there. I'm not personally doing that at this juncture. I'll let you know if I do, of course. With that, let me know down in the comment section below whether you agree or disagree with me and why you agree or disagree with me. And if you're new here, returning 9, subscribe, please subscribe down below. With that, have a great rest of your day. Stay blessed. Keep 10 toes to the ground and your chin up. Peace out.